All right, so what we're supposed to have tonight is our guy. I got asked if someone can come on a podcast, and he's going to talk about cost segregation and doing bonus depreciation, like that whole thing when we buy buildings. So I want to make sure that he's got yeah, his name is Eric Oliver, and now we're just waiting for Eric to join. So. Um, But yeah, I want to hear what everyone's up to right now. Other than, like I said, about an hour ago, we had our Respark call. Anybody working on anything big right now as we're waiting for Eric to join? Well,
I've
yeah.
got a guy with, I got a guy that's got foreclosure breathing down his neck, so they might try to buy some time with a Chapter 11, and we're still just like floating around, seeing what we can do. We might lend him the money to get him caught up. I don't know yet, but we do have one person that came from the Respark, just from the agents and outreach and all that. So
Oh, really?
yeah.
Pretty strong.
Yeah, so we'll see what happens. They're gonna try to buy one more time. What they can do Chapter 11 one more time to just like delay it and see what they can do. So we'll see. We might negotiate the debt down with a short sale, have our buyers buy it, lease it back to them. So more to come.
Awesome, man. Well, it looks like I just
Hey,
shot a
are you
email.
there, Nolan? Can you hear me okay?
Hey, how you doing, Eric? What's going
Good.
on?
How's it going?
Good to see you, man. Thank you for making it on. I wanted to very quickly. I'll give you the introduction here, and I'll turn the the ability for you to control everything over if that works. Again, I want to introduce Eric Oliver. He is a cost segregation expert, I would say, and all of us that are in commercial real estate, this guy can help you in everything that you do. And other than that, Eric, I like you just to take it away, man. You're the professional, brother.
Yeah, no, tell me, Nolan, how much time do we have just so I can kind of gauge?
We're here for an hour. We're here until 7 o'clock Central. So you got 56 minutes to go, brother.
Okay. All right. Okay. I'm just thinking. I, I thought we were doing a podcast recording. I didn't know, so I could make this work though. We're good.
Oh, I'm sorry. I'm sorry. No,
No,
I
you're good.
got it.
I didn't have anything prepared, and unfortunately, I just got a new computer. My computer's transferring data back and forth, but so I
Well,
don't
don't
have a
even worry about
PowerPoint.
it. Again, this is more about if anything else. I mean, I can share my screen with something else. More importantly, this will go on a podcast once we put it out afterward.
Perfect.
The audio, of course, but most importantly, we're thankful to have you on tonight.
Okay. No, absolutely. And so let's talk. I'll kind of just, for those of you who don't understand what cost segregation is, I think we'll start there and then we'll touch on four or five different topics, kind of more of an advanced cost segregation, some different um, bonus benefits of cost segregation that people aren't always familiar with. So, kind of to start, as Nolan mentioned, my name's Eric Oliver. I'm with a company called CSA Partners. We've been doing cost segregation studies for about the last 20 years. So cost segregation's been around for quite some time. Um, in the early years, it was mainly for your really large commercial buildings. So if you owned casinos, hospitals, hotels, they were all doing cost segregation over the last 20 years. With some of the changes to the tax laws, cost segregation has become a lot more um, accessible for smaller investors. So, for an example, we do everything from single family rental homes all the way up to ski resorts and large office complexes with multiple buildings. So, cost segregation can be applied to all types of revenue generating assets. And really, what cost segregation is it's just accelerated depreciation on your real estate assets. So, most of you may be aware that that depreciation is taken over 27 and a half years for residential units or 39 years for commercial units. So if you buy just to make the math easy, let's just say you buy a $270,000 office single family home, 275,000 divided by 27 and a half, you're getting a $10,000 write off every year for the next 27 and a half years. Pretty straightforward. Cost segregation says, well, listen, I'm not going to hold that asset for 27 and a half years. Typically, I might, turn it over after 5 or 7. So I want my deductions now versus letting the IRS hold on to these over 27 and a half years. So same thing with an office building. Say I buy a $27 million, or excuse me, a $39 million office building. I take 39 million, divide it by 39 years, and I'm getting $1 million write off every year. But I'm only getting 1/39th in that example, and I want more of it up front. So the way you can do that is through an engineering-based study where we go in and we identify the different assets that the IRS has put forth as short life assets. So just as our name implies, we're taking the cost. Let's use the single family rental as an example. We're taking that $275,000 of cost. We're breaking it up into different buckets. Now, the IRS tells us where each item goes and what bucket it goes into. So, for example, there's stuff in your single family rental called personal property. Personal property is things like the carpet, the countertops, the cabinets, ceiling fans, the window coverings. Those are all things that are usually on the inside of a home. Those don't last 27 and a half years. They last on average 5 years. Now, I should be careful when I say that. It's the depreciable life of an asset doesn't always make sense. So, for example, the IRS says that a roof is a 39-year asset or a 27 and a half year asset, and most roofs don't last that long. Same thing with air conditioners. Most air conditioners don't last 27 and a half years. So it's not necessarily the actual useful life of that asset. It's the category that the IRS has put that asset in. So we go in, we identify the short life assets, and we break those out. So in that example of the $275,000 single family home, your tax preparer, your CPA or EA, whoever's doing your taxes, they can now depreciate your carpet over 5 years instead of spreading that out over 27 and a half. They can depreciate your appliances over 5 years versus 27 and a half. So by doing that, we're front loading the depreciation, which gives you a much bigger write-off in the early years. Now, why would you want a bigger write-off in the early years? Well, there's a couple of reasons. One, there's time value of money. So a dollar today is worth way more than a dollar in 27 and a half years. So give me my deductions now versus letting the IRS hold on to these deductions for the next 27 and a half years. That's the first thing. Second thing is inflation. Obviously, again, along the same lines. Inflation is only going up at this point. And so give me my deductions now versus the IRS holding on to these. And the other thing is just cash flow. I want to free up cash flow in those early years of ownership so that I can pay down my debt. I can take that tax savings and I can go buy new properties, again, pay down my debt, hell, invest it in Bitcoin. I don't know what you do with your money, but you have that cash to be able to do something with it. And so that's the whole idea. That's kind of a really high level overview of cost segregation and what it is at its simplest form. So hopefully that makes sense. I don't know if we have it open to questions, Nolan, but I'm happy to take questions. If anyone has any questions on hopefully that makes sense at a high level. If not, make sure you guys speak up. I'm happy to reiterate anything there. But so that's cost segregation at a high level. Couple of things you want to consider when doing cost segregation. So we always will do what we call a free benefit analysis, where we look at the property before ever engaging a client. And the reason we do that is a couple things. One is we want to make sure that the asset is going to create a significant tax savings. And what we're looking at, I speak for myself, we're not tax advisors here. We always say consult your tax advisor, your CPA. But we do want to consult on whether or not cost segregation is right for you, because it's not right for everybody at this moment. Cost segregation is one of the few assets that the few expenses that I'm familiar with in real estate where you can kind of pick and choose when you do cost segregation. So we get asked all the time, hey, can I do cost segregation? Is now the right time? And that's probably a question that we want to have with your tax preparer, because there's a number of variables that go into that. But some things to consider are, one, do you have taxable income? So if you had a bad year financially, you had not a lot of income coming in, maybe you had some other write-offs from some repairs on some of your buildings or whatnot, maybe you don't need the additional deductions, because just because we can create a deduction doesn't mean it's going to equate into a tax savings. Because again, we're creating, remember, a deduction is, or depreciation deduction is just a non-cash expense. So these deductions come off of your taxable income. And that's how you save money. That's how you save taxes. But if you don't have any taxable income or very little taxable income, then creating a large deduction doesn't always help you. And so one of the things you want to determine when you're doing cost segregation is, do we have a need for these deductions? That's the first thing. The second thing is, what kind of deductions and what kind of income do we have? So there is something called passive income and there's something called active income. So I am a W-2 employee here at Cost Segregation Authority. And so when I do cost segregation studies on my long-term rentals, I can't use those deductions to offset my W-2 income. Because those deductions, I don't actively do real estate for a living. I have a few rental properties on the side. I do cost segregation for a living. So those deductions are considered passive. So inherently, deductions from real estate are usually considered passive, and so they cannot be used to offset your active income. Now, there's a couple of ways around that, and this is something, again, you're going to want to talk to your tax preparer about. But the first way is that's becoming a real estate professional. So a lot of you've probably heard of becoming a real estate professional for tax purposes. When you become a real estate professional for tax purposes, you're telling the IRS, hey, I do real estate for a living. This is my active daily, this is what I do. Therefore, because I'm actively doing this every day to earn money, these deductions can be considered active, and you can use your deductions from your real estate to offset your active income. Now, to become a real estate professional, there are a couple tests. One is you have to spend 750 hours a year doing real estate, and you have to spend 51% of your working time doing real estate. So the 750 hours a year, that's about 14 hours a week. Pretty straightforward. You spend 14 hours a week. That's a pretty easy test to meet. The harder test is the 51% of your working time. So I'm a W-2 employee here at Cost Seg Authority. I spend 40 hours a week doing cost seg work. In order for me to qualify as a real estate professional, I would need to do 41 hours a week doing real estate. And if I try to tell the IRS that I'm working 81 hours a week, they're going to call BS on that. And then I'm probably going to get audited, and they're going to throw it out and say, no, you're not a real estate guy. You're really a cost seg guy. So what a lot of people will do is they will have a spouse qualify. So let's use the example where I'm a doctor. I make $500,000 a year. I take some of that money. I go buy investment properties. My spouse, because I make $500,000 a year, they're fortunate enough to be able to stay home. They don't have to work. If my spouse can prove that they manage our properties and spend at least 14 hours a week, they meet all the tests. They're spending more than half their time. They're spending the 14 hours a week, and they're managing our properties. Now I have my spouse become a real estate professional. And because we file a joint tax return, me and my spouse, all of the deductions that we create from our real estate now are considered active, and they can be used to offset my active income. So that's the first test. But now that doesn't work for everybody. Not everyone has a stay-at-home spouse or somebody who just does real estate for a living. So there's a few other ways to get around this active versus passive. One of them we'll talk about quickly. I don't know how relevant it is for your audience, but it's the short-term rental loophole. Some of you have maybe heard that. I actually took advantage of that myself because I am a W-2 employee. My wife happens to work in the school district. She's a W-2 employee. And we had a tax problem at the end of 2022. So I was going to owe a bunch of taxes. We had a good year. I was going to owe a bunch of taxes. And I did have a long-term rental. But again, if I did my cost seg study in the long-term rental, I can't use that to offset my W-2 income. So what we did is, it was November, we went out and bought a short-term rental. So short-term rentals, your Airbnb type properties, they get treated a little bit differently than a long-term rental. Short-term rentals don't get treated as real estate. They get treated as like a commercial business. So think of it more like a hotel. So if the average stay at the Airbnb that we bought is less than 7 days, and I can show that I manage that business. I manage my Airbnb business. So there's 7 tests. They're called the material participation test. You only have to meet one of the 7 tests. The test that me and my wife met is we spent 100 hours at the property throughout the year, at least 100 hours, and more time than anyone else. So because I bought it in November, I was there more than our cleaner through the year. I was there more than our maintenance folks. Because we could show material participation and the average stay was less than 7 days, we were able to treat that as a short-term rental. We did a cost segregation study on it. I'll just share the numbers with you. We put 80,000 down. It was about a $400,000 property. When we did our cost segregation study, we created about a $145,000 deduction, which means I was able to offset my W-2 income by 145,000, which if I'm in a 35% tax bracket, that's about a $50,000 tax savings. So I put 80,000 down that I was going to have to just pay to the IRS anyways. I put that down on a property, created a $50,000 tax savings. So I basically picked up a revenue generating property for about $30,000 out of pocket. Again, the other 50,000 would have just gone to the IRS and I would have never seen it again. So that's one way. That's called the short-term rental loophole. Again, it's basically you're running a hotel. Because you're running it, you're actively involved in this hotel business. Those deductions are considered active, and they can be used to offset active income. And then the last way that I'll talk about, just to get around the active versus passive, because this is a question we get asked a lot, is when you sell an asset, you can use your cost segregation or your passive losses to offset that capital gain on the sale of a property. And so if you do a cost seg study, we create, I don't know, $500,000 of deduction. And let's say you only have $100,000 of passive income, you can offset that passive income, but that leftover 400,000, it can be used to offset a capital gain event. So maybe I have another property, let's call it property B over here. I sell that property. I make $500,000 on the sale of that property. I'm going to have to pay tax on that. Usually capital gains is taxed at about 20%. So I'm going to have to pay $100,000 in taxes on that. I can use this $400,000 of carried forward passive losses to offset that capital gain. So there's a number of ways, even if you're not a real estate professional, even if you don't have a lot of passive income, to be able to utilize cost segregation and these large deductions that it creates. So again, just something you want to talk to your tax preparer. Cost segregation is not for everybody, but if you are in that situation where you have a lot of passive income, you've got a large capital gain event, cost segregation might make sense to be able to offset that gain or that passive income. So, any questions on that? That's kind of just a quick overview on active versus passive, because that is a big factor in whether or not you can utilize the deductions.
100%, Eric. I'd like to, I mean, first that is, I mean, that's inside info that you really can't get anywhere, which is awesome. I like to use the example, and I'd like to hear your opinion on this. What Richard's asking, what is the cost of these studies? So let's get into that in a second. Uh,
Yeah.
I would say this, Richard. I think it's always the juice is always worth the squeeze. Always worth paying for something when you get massive hundred thousands of deductions. But I like to ask you, I like to use this example. Let's say you buy $1 million building. We kind of focus, our group kind of focuses on like light industrial buildings, commercial
Okay.
property, a 39-year depreciation, amortization kind of thing. My question would be, and this is the way that I try and teach people, is you do a cost segregation study. Of course, they're stepping the basis down. Now it's 40% this year, the whole thing on bonus depreciation. If you buy $1 million building, you do a cost segregation study. Let's just say that let's use hypotheticals. Let's say the bonus depreciation on that building would be $150,000, for example, right?
Okay.
And somebody was to have an engineering job, and they were earning a salary of $150,000. Usually, Uncle Sam is maybe withholding 50,000 of that in a third party to send that to the government every 2 weeks. You see that number. Is it fair to say that if someone earns 150,000 in their engineering job and then they purchase a property, which we try and do creative real estate, they lose $150,000 and their spouse is a real estate professional, you know, maybe the spouse likes to go be really into spreadsheets or really just likes to drink prosecco at open houses, right?
Right.
It's up to them, right? You know how it goes. But what is it fair to say that this income and this loss offset, and then that 50,000 that was being withheld by their employer would be refunded back to them at the end of the year? Can you kind of can you educate and enlighten us? I mean, I think
Yeah.
that I'm onto that, but I want to make sure I'm hearing it from the professional properly.
No, no, you hit it right on the head. So you're exactly right, especially with the real estate professional piece of the spouse being a real estate professional. Now, my engineering income is considered active income, but also because my spouse is a real estate professional, the deductions from that cost segregation study are considered active, and so they will offset. Now, I will say it it doesn't always make sense. That was a great example. I just want to say it doesn't always make sense to offset your income completely. Now, this would be more the case where you've got some flexibility where maybe I've got two or three buildings. I've got 150,000 of income. I don't necessarily want to do cost segregation on all three of those. Create a $300,000 deduction to offset my income and pay no taxes. So remember, your income is taxed at different rates. So what you want to do is you want to use cost segregation to offset the income that's taxed at the higher rates, but you don't want to use those deductions and blow through them on income that's taxed at those lower rates. Just go ahead and pay your taxes at 10, 12, 15% on that small amount. You just don't want to be in that 35, 37% tax bracket. And so
Smart.
you want to, in order to maximize your tax savings, it's better to bring your income down. And let's use your example from 150 down to 50, and then do the same thing again next year
Okay.
versus bringing it all down in year one. Now, you can't always do that because cost segregation, if you decide to do cost segregation on a building and it creates, in your example, $150,000 deduction, you have 150,000 of income, then you can't say, well, IRS, I don't want to use the full 150. Just let me use 100 of it and I'll go ahead and pay the tax on the 50. You don't get to make that decision.
Understood.
I say you don't get to make that decision. There are a few levers that allow you to kind of manage what that deduction is. And let me talk a little bit about that. So you had mentioned something called bonus depreciation. Bonus depreciation is bonus depreciation has been around for a number of years. The government uses it to stimulate the economy. So they'll say, hey, the economy's struggling, so we're going to increase bonus depreciation to 80%. And then the next year, the economy's doing well, and they're like, well, let's bring it back down to 30%. But the idea behind bonus depreciation is it incentivizes people to go out and buy stuff.
Mm-hmm.
So when they have it at 80% bonus, essentially, if you went out and bought $1 million bulldozer, instead of depreciating that bulldozer evenly over 15 years, you would get to take 80% of that, or in that example, if it's $1 million bulldozer, you'd get to take $800,000 depreciation up front. The remaining 20% gets spread out over the useful life of that bulldozer. So you can see if you have a tax liability and they offer 80% bonus, they're saying, hey, go out and buy stuff at the end of the year, and we're going to give you these huge write-offs for doing so, and then you don't have to pay as much tax. So let's back up to 2017. Bonus depreciation was at 50%. Bonus depreciation could only be utilized on assets that were brand new. So you couldn't buy a used bulldozer. You had to buy a brand new bulldozer. And it was 50%. At the end of 2017, with the Tax Cuts and Jobs Act, this was part of Donald Trump's tax overhaul. Donald Trump owns real estate. Donald Trump overhauled the tax code, and he made it very favorable to real estate investors. A few things happened. One is he went from 50% bonus to 100% bonus, which was huge. So now in my bulldozer example, I buy $1 million bulldozer. I get to write off 100% of that, or $1 million all in the first year. So that's huge because before that it was 50%. That's the first thing. And just as an FYI, 100% bonus was available to any assets placed into service between 9/27 of 17. So if you bought anything between 9/27 of 17 and 12/31 of 2022, you were eligible for 100% bonus. I see in the chat here someone said it's 40% for this year, which is correct. So it basically lowers 20% every year after 2022. So in 2023, it went from 100 to 80. 2024, it was 60. 2025, here it's 40. And then it'll slowly phase out down to 0% in 2027. Now, I say that hoping that 100% bonus is going to get extended. Congress put forth a bill last year to extend it through 2025. It made it through the House almost unanimously, bipartisan support, got to the Senate. The senators said, wait a minute, we're in the middle of a presidential election. If we pass this is going to look good for the Biden administration. So they kind of just canceled it and said, hey, we're going to revisit this after the presidential election. So I've already heard talks about Trump and his administration. They've already talked about a comprehensive tax bill. And I do think the 100% bonus will get extended. Yeah. Whether they tell you this or not, everyone in Washington owns real estate, whether they're Republicans or Democrats, they all want to pass it. So usually when that's the case, things get done. So I do think 100% bonus will get passed, but currently that's the phase out period. So back to 2017, that was the first big change, went from 50% to 100%. The other big change that they did is they added 5 words to the tax code that made all the difference in the world. They added the words, remember I told you it had to be a new bulldozer? Well, they added the words new to you, the taxpayer. I think that it might actually be 6 words, but new to you, the taxpayer, that has all kinds of implications because now I don't have to buy a used bulldozer, a new bulldozer. I can actually buy a used bulldozer. It's new to me, Erik, the taxpayer. And so now I get to take bonus depreciation on it.
Nice.
So I don't think all these people in Congress who voted for the bonus depreciation even realized that it would have such a huge impact on real estate because a lot of them think, just like there's CPAs out there that think, bonus depreciation doesn't apply to real estate because in order to take bonus on an asset, the asset has to have a useful life of 20 years or less. So we've talked about, Nolan, residential rentals are 27 and a half, commercial properties 39, so technically they don't get bonus. Well, that's true until you pay for a cost segregation study. We're going to take that 39-year asset, we're going to break it up into 5, 7, and 15-year buckets. And now those 5, 7, and 15-year assets, they're all under the 20-year mark, and so they're eligible for bonus. So I don't know how many of your listeners buy bulldozers, but let's talk about real estate since that's what we're here to do. So how does this apply to real estate? Well, after 2017, the end of 2017, if I went and bought a used, if I went and bought an existing property, so not a new building, I went and bought an apartment building or an industrial building that was built, let's talk an industrial building. I went and bought an industrial building that was built in 1970. I can go in, do cost segregation on it, identify all the short life assets, and now I get 100% bonus on those if I bought it during that 100% bonus period. So just to give you an idea, we usually segregate around 30% is kind of an average. Manufacturing, warehouses, they might be a little bit less because sometimes you just got a big empty warehouse with 4 walls and a cement floor. There's not a lot for us to segregate. So you might get 20, 25%. Go into multifamily, some multifamily, industrial. Sometimes it can be great, but you're getting like 30 to 35% segregation. So you think if you buy $1 million industrial building and we get 30% segregation, we're going to find $300,000 worth of stuff that we're going to put into those 5, 7, and 15-year buckets. The 5-year stuff is your personal property, equipment, machinery, ceiling fans, that kind of stuff. Not a lot of 7-year assets. That's kind of your telecommunication lines, cable lines, internet services, that kind of stuff. And then your 15-year stuff is all your exterior. So your curbs, gutters, asphalt, concrete, pavement, trees, bushes, shrubs, retaining walls. That all falls in the 15-year bucket. So if you buy $1 million asset and we find 30% of that we can resegregate into those short life assets, and then you bought it during a 100% bonus period, You're now getting all of that, all 300,000 of that in year one as a write-off.
So
Where if you don't do cost seg, I don't know the math on this, but on that same $1 million building, you take $1 million divided by 39 years. If you don't do cost seg, you're getting a $25,000 write-off.
minus the land.
Minus the land. Yeah, I'm oversimplifying things a little bit because I'm not
Yeah.
including land. Land is non-depreciable. That's a great point, Nolan. You always have to back out your land value. But let's say my building, after I pulled out the land, was $1 million. If I did a cost seg study on it, or if I didn't do a cost seg study, I would get 1/39th of that as a deduction every year for 39 years. And I just did the math, and that's $25,000, 25,641.
Yep.
By doing a cost seg study, especially when there was a bonus period of 100%, I would get, if I found 30% or 300,000, I would get all 300,000, 100% of that as a write off in year one. So you can see the power of bonus depreciation. Now, we're in a 40% bonus period right now. So let's say we use that same $1 million building. We segregate 30% of it. So we have $300,000 available to us, but I'm only eligible for 40% of that in year one. So 40% of 300,000 is 120,000. So still, I'm getting 120,000 in year one versus had I not done a cost seg study, I'm getting 25,000. So still very good numbers, but
Just knocking down the incentive, though. That's the thing.
yes.
I have a question, Eric, and of course, I'd love to open this up to everybody too. I'm curious to know when someone does a 1031 exchange, how does that affect bonus depreciation? How does that affect your cost segregation with depreciation recapture? How does that whole thing kind of what's the strategy there?
Yeah, that's a great
If you
question.
don't
So,
mind explaining that to our crew, like exactly the question I'm asking, and then giving us your
yeah,
opinion.
no, that's a great question. I'm going to kind of break it up into two pieces because there's kind of two questions in there. So let's first talk about depreciation recapture because that is a probably the most complicated thing we'll talk about tonight. And I'll try and keep it as high level as I can without getting too far in the weeds because that's a question we get asked all the time. So when you sell an asset, you pay two types of tax. You pay capital gains tax and you pay depreciation recapture. And depreciation recapture is calculated based on how much depreciation you've taken. So I'm sitting here telling you, hey, front load this and take as much as you can up front. And sometimes investors and CPAs will say, well, Eric, this is just a timing issue. If I take all this depreciation up front, I'm just going to have a bigger tax bill when I sell it in 5 years. So isn't it kind of a wash? And the answer is no, it's not. And I'll explain why. The idea there is when you do cost segregation, I'm getting my deduction against my ordinary income. So let's say I'm in a 35% tax bracket and I get a $100,000 deduction. So I'm reducing my taxable income by 100,000 and I'm getting charged 35%. I just saved myself 35,000 in taxes. If and when I sell that building in 5 years, I'm going to pay that 100,000 of depreciation back at either a capital gains rate of at most 20%. So let's say I pay it all back as capital gains. I took the deduction at 35,000, I'm paying it back at 20,000 and saving the spread. So I'm coming out ahead 15,000. I don't always pay it back at capital gains. Sometimes it gets paid at depreciation recapture rates of 25%. So again, even if I take it at 35, I'm getting a $35,000 tax savings. Paying it back at even if I pay it all back, I'm paying it back at 25% and paying back 25, so I net 10. Now, so take your deduction at a high rate, pay it back at a lower rate, save the spread. That's the first piece. Second piece is I'm not even paying it all back. I'm paying some of it back. And let me back into this example because I think it'll make more sense. Let's say I like that $1 million number because that's easy math in my head. So let's say I buy this office building for $1 million. I buy everything in here. I buy the window coverings, the flooring, the parking lot, everything here for $1 million. 5 years later, I sell it for 2 million. Sell the building, the parking lot, the window coverings, flooring. I sell it for 2 million. When I go to settle up with the IRS, I'm telling them that everything is doubled in value. I bought all this stuff in this building for 1 million. I'm selling this building and all this stuff for 2 million, so everything's doubled in value. Well, the land has gone up in value. My walls, my structure has gone up in value. But certainly my carpet that's 5 years old and stained is not worth double what I bought it for.
Nice.
So if you remember what I said earlier, carpet's a 5 year asset. So what is the value? What's the book value of my carpet after owning it for 5 years in the eyes of the IRS? It's zero.
Zero.
Has zero book value. So when I go sell my asset, when I sell this building, I should be selling my carpet for zero, saying it's not worth anything. And I should be paying no tax on that. I didn't gain any value. I didn't gain any money by selling my dirty old carpet.
Nice.
And what I do when I do that is I shift everything over into that 20% capital gains bucket. And that's where I want it to be, because that means I'm paying it back at 20%, which is a bigger spread. So in summary, I'm taking my deduction at a high rate of, call it 35%, paying back a portion of it. That portion is dependent upon how long I've owned it, paying back a portion of it at a lower rate at a future date, and I'm saving the spread. And so that's, again, recapture is a complicated topic. We could probably do a whole hour on recapture, but if you remember anything from the last 5 minutes of me talking, don't sell your dirty stained carpet for more than you bought it for. And that's what you're doing. Because remember, if we used our example, I bought all this stuff for $1 million, I'm selling it all for $2 million. If I don't do a cost seg study, everything's just lumped together. I can't pull my carpet out. So this, Nolan, is why we work with a lot of commercial real estate brokers who they will call us and say, hey, client just reached out to me. They want me to sell their building. They bought it 10 years ago for $1 million. I'm selling it now for $2 million. Can you hurry and do a cost seg study before this transaction closes and we no longer have access to the building? The reason they want to do it right before, which some CPAs will be like, well, Erik, that makes no sense. You're doing a cost seg study now. They're going to save a little bit of money now, but they just got to pay it back in the future when they sell it next year on their taxes. And I'm like, well, yeah, but they pay it back at a lower rate on a lesser amount and save the spread. So the reason we do those is because we want to know what the carpet was when they bought the building, so that when they sell it, we can allocate that sales price to the right buckets, which helps create a tax savings. So that was a long answer to the first half of your question. What is depreciation recapture? So now let's talk about a way to avoid all of that recapture, and that's through what you mentioned in a 1031 exchange. So the government has put out a tool that allows us and encourages us to sell our properties. Because if I bought a property for 250,000 and it's now worth 10 million, I have no incentive to sell that property, because when I go to sell it, I'm going to get hit with a huge capital gains bill. So a lot of people would just sit on those properties. There wouldn't be any transactions. They would just pass them down to their estate. Nothing would happen. So to prevent this, the IRS has issued guidance on 1031 exchanges. They have provisions that allow us to do 1031 exchanges. And what that does is it allows us to buy a property for $1 million, sell it 5 years later for $2 million. We take that $2 million and we go reinvest it, or not all of it. We can take some of it or the full amount. We go reinvest it in a new property. And as long as we buy a property that is larger in value than our previous property, then we can defer all capital gains and all depreciation recapture. So maybe you've heard the term swap till you drop, or I always just say,
Buy, borrow, die.
what is it? Buy, borrow, die, right?
Buy, borrow, die. Yeah.
Right. Same idea is you just keep swapping or exchanging these properties. So let's say I'm 20 years old. My initial property is 500,000. 5 years later, I sell it for $1 million. 5 years later, after that, I sell it for $2 million, and I just keep going from a fourplex to an eightplex to a 16plex. It just keeps getting bigger and bigger.
Yeah.
I eventually die, unfortunately. I pass that on to my estate. My estate will get a step up in basis to fair market value at the time of my death, and they pay no taxes on it. Mm-hmm. And so it's a great way to preserve wealth. If I just sell a property, if I sell $1 million property and I have to pay 20% capital gains tax, I could have a $200,000 tax liability. But to keep that $200,000 of value within my estate, I just do these 1031 exchanges. And as long as I'm investing in larger properties, the government allows me to do that. So you're just kind of kicking the can down the road until you die, unfortunately. and then everything gets stepped up in basis and no one pays tax. So let me just talk quickly. How does that affect the cost segregation? The IRS doesn't allow you to do this without some ramification. So the 1031 exchange, think of it as you're just adding a little bit more to your investment every year. But that original investment, if I do a cost seg study, I'm reducing my basis by the amount of depreciation I've taken. So when I go and add or invest in my second property in the exchange, I have to reduce this amount by how much depreciation I took in the first property. So it doesn't have a negative impact unless you're not really investing in larger properties. So let's say I go from 1 million to 1,500,000. I'm only adding $50,000 worth of basis there. I shouldn't say 1,500,000, $1,500,000. So I went up $5,000. I'm only adding $5,000 of basis, which means I'm not really adding a lot to my initial investment. But if you go from $1 million property and go buy a $2 million property, I just added an extra $1 million worth of basis. So it doesn't really matter how much depreciation I've taken here. I'm just pulling it out of this one.
Okay.
So just remember that you do have to reduce your basis by the amount of depreciation you've taken. So when you're doing cost segregation, you're reducing it by more. But as long as you're investing in larger properties, you do a cost segregation on this property, you go buy a $2 million property, you do cost segregation on this $1 million of extra basis you just added, and you keep doing that as long as you move on. So 1031 exchanges work great with cost segregation, and it's a great way to preserve wealth. Nolan, I wanted to get back to one question that I didn't answer. I know somebody asked, and you had mentioned it yourself, but just the cost of these studies. Cost segregation, the IRS doesn't unfortunately allow us to bill a percentage of our tax savings. I wish they would, because I'd be on a beach somewhere retired, but I'm still here sweating it out. So
That's right.
we charge a flat fee based on the size and scope of each property. So the big factors that go into that are the type of asset. As you can imagine, a big empty warehouse, that's really easy. I wouldn't say really, but it's easier for us to do than a strip mall where we've got to go look at, the T-Mobile store. We got to look at the Wingstop. We got to look at all the different individual tenants. That's a lot of work. So type of asset, the square footage of the building, and the size of the lot. Those are kind of the three big factors that go into our pricing. But I'll give you an idea on our pricing. We're usually, for single family rentals, we're right around $2,700 to $3,000 for single family rentals. For larger properties, it kind of goes up from there. We do ski resorts where it might be $50,000 because we're doing multiple restaurants and lodges and whatnot. But usually you can see somewhere between at a minimum 7 to 10x return on your investment. So if we're
Yeah.
charging you $3 for a study, you should be saving $30,000 in taxes. Now,
Yeah.
again, that depends on your tax bracket and whether or not you can utilize it all. But that kind of gives you an idea of the expected tax savings, as well as our fee. So I know that's a wide
Where
range,
do you guys,
3,000 to 50,000.
are you guys like specific to a particular region of the United States? You guys do it like, how do you dictate on the
Yeah,
location?
no, that's a good question. So we're actually a national company. There are a few of us that are national companies. We've got 10 satellite offices throughout the country. We do studies in all 50 states. One of the great things that came out of COVID, all of our engineers are housed here at our corporate office just outside of Salt Lake. And prior to COVID, we would actually send our engineers to every single property. We would put them on a plane and have them fly to Maine to look at a small residential rental. And then
Wow.
we'd have to pass that cost on to the company or to the client. But one of the great things that came out of COVID is we do a lot of our site visits virtually now. So on all the smaller assets, we can, because of the travel restrictions during COVID, the IRS changed their rules a little bit and said, hey, so we do a lot of video conferencing, similar to what we're on now, like a Zoom call or a Teams meeting where we have a property manager, a tenant on one end. We're saying, hey, show us the flooring, show us the electrical panels, take us out. Is there any retaining walls? We need to document certain stuff in order to do the cost seg study. And that can oftentimes be done virtually. It keeps the cost down for everybody. On larger projects where, it doesn't make sense to have a property manager walking a 8-acre apartment complex for 4 hours, we actually will send our engineers out to do that kind of stuff. But but yeah, that's kind of the process there. You know, the IRS does require that site visit, so we've got to go look at each of the properties.
Sure.
But we do studies in all 50 states, so that's yeah, wherever the properties. We've even done some foreign properties in Canada and Mexico. So
Well, we have investors in our group from all over the country. So if you're not opposed to this, Eric, last 15 minutes, I'd like to open it up to everybody
yeah,
to hit with some questions. So everybody, if you got something on your mind, please ask Eric. Obviously, this has been awesome. I'm getting totally educated. So if someone has something on their mind for Eric, please ask away. Or I don't mind going. I don't mind asking questions. It doesn't bother
oh,
me.
he said someone asked. There's some questions I think that are coming in through the chat here. So someone
Oh,
asked,
okay, okay, okay.
my full name is Erik Oliver. That's Erik with a K, Erik. My Erik last name's Oliver, Oliver. Common spelling there, but the company is called Cost Segregation. Well, I got to be careful. We went through a rebranding on February 1st. So
Okay.
prior to February 1st, our company was called Cost Segregation Authority. After February 1st, going forward, we're now CSA partners. So
There you go.
our website is just www.csap.com. So I love the new name. My email address is much shorter now. It's just eric@csap.com.
Nice.
But you can find us online. Um,
We'll share it. We'll share all your information.
Perfect. Yeah, my
Everybody-
contact information's out there. We do free benefit analysis on our website. If you guys or any of you listeners have a property that you think might be a benefit or might be a good candidate for cost segregation, you can put that on, go to our website, input a little bit of information. We'll do a free analysis to say, hey, we can create this big of a deduction. It's going to save you this much in taxes, and here's what our fee would be. And we usually turn those around in a day or two. But yeah, good. That's the best way to get a hold of us.
Awesome.
I
Yeah.
thought I saw another question come in. Was there another question? I think that was it.
I got a
Oh,
Oh,
go
it looks like
ahead,
Zach
Zach.
has
Go
a
ahead, Zach.
question.
I got a quick two-parter for you, Eric.
Yeah,
I want to start off by saying thank you. That was absolutely fantastic.
Hey,
Really appreciate it. Great information.
yeah,
So I guess my question to you is, I know obviously you have to be real estate professional or have to have your spouse be a real estate professional to take advantage of that bonus depreciation, right? My two parts for you. Is there any other workarounds that you know of other than, I know you mentioned the short term rental loophole, or the second one that you mentioned? Is there any other workaround if you do have a 40-hour week W-2 job without a spouse? And then the second part to that, if you can't, is that something that you can, I guess for lack of a better term, kind of kick the can down the road and utilize that bonus depreciation when in the event that you are or do become a real estate professional?
yeah. That's a great two-part
Zach,
question.
sounds like
So
you need to start dating, bro.
I was just gonna say, so
No
Zach, the
doubt.
only workaround I know is to get married, and I've
Yeah.
been married for 20 years, and I don't know that I suggest that. I don't know if my wife listens to this, but for some of us that's worked out great. For some of us it doesn't work out great. So I don't know that that's a high quality workaround is to get married to a real estate broker, but I don't actually know any other way. There are, I can share a couple, let me share a couple ways, or a couple, I don't know that it's ways, but a couple different ideas I have. One is there is something called a grouping allocation. So I don't know if this would apply to you or not, but if you operate a business out of the property that you do the cost segregation study on. So think of this kind of like your dentist. So let's say I'm a dentist. I have a company over here that's my operating company. This is the company that gets paid for my dental work. I also have a real estate company because I bought the building that I practice out of. So because I practice out of this building and I work out of this building, I can do a grouping allocation where the IRS says, hey, the only reason you really have that piece of real estate is because it's part of your business because you're a dentist and you need a medical office. So they allow you to use the deductions from your cost seg study to offset your dental income. So that's one thing. So if you're buying a manufacturing building or an industrial building and you operate your business out of there, there may be an opportunity to utilize that grouping allocation.
You got to be an owner user then, right, Eric? Is that what you're
Yep,
saying?
exactly.
Okay,
Yep.
understood. Okay.
So the second way, or the second part of your question is, hey, what if, oh, now I'm drawing a blank. The second part of your question was, oh, the banking. So
Mhm.
yes, those deductions. So let's say you invest in a syndication or a partnership, you give them some money, they kick you a K1 and it shows a big negative number. And you're like, well, listen, I'm an engineer. I can't use that deduction this year. It does just carry forward and you can utilize it in future years and you can use it for tax planning. So sometimes I've heard of ways where people will convert retirement income and use the deductions to offset retirement income so they can pull in retirement monies out early and not have to pay tax on that retirement money.
Strategy.
Again, I don't know exactly how that's done. Get with your tax preparer, your tax strategist, but there are ways to do that. You don't ever lose those deductions. Um, they just kind of sit in that bucket until you can utilize them. There is a little bit of limitation on that. I think you can only offset up to 80% of your total income every year if you're using it on a go forward basis. So they don't let you wipe it out every year. The government wants you to pay a little bit of tax. So you have to pay, I think you can, like I said, or you can offset up to 80% of your income, but you don't ever lose it. It does just carry forward. So again, if you're investing in syndications or partnership deals, don't worry if they do a cost seg study and you have this big deduction. Just know that you're not going to pay you're not going to pay any tax on any income that comes from that investment property or any
Mhm.
other investment properties you have, but then anything that's left over does just carry forward. So hopefully I was able to answer that.
Okay. No, yeah, I got it. That was perfect. Thanks, Eric.
Uh-huh.
That's a great strategy too, Eric, talking about taking your depreciation deduction against some of your potentially tax deferred accounts that are out there that
Right.
that's coming. Uncle Sam is just going to keep increasing taxes and that's a great offset,
Yeah.
I guess. Yeah. Who else? Who else has something for Eric? We got about just under 10 minutes to go. Who else has something for Eric? This
Hey
is
Eric, Ariana here.
Hi,
hey.
Adiana.
Thanks for everything. I'm now the yeah, this is my daughter Gisela. I'm now the real estate professional. I'm the spouse. So what you talked about, the first option here.
Okay.
Excited to get going. Would it be beneficial to create an LLC as well? So we've got one single family property that we've utilized. It's paid off. I've never done
Okay.
a cost segregation on it, and we're trying to obviously acquire now industrial type things. Would it be beneficial to create an LLC? And also with this property that we have, can I go run a cost segregation on it now that I'm the business or the real estate
Real
professional?
estate professionals. So let's talk about the property you have. How long ago did you buy that property?
2008.
And was that your primary residence and then you turned it into a rental, or was it a
At the
rental
time,
from the
yes,
start?
right out of college, and then I
Okay.
moved.
Okay. So that was your primary property. When did it become a rental property? What year?
To Well, this is the thing. It was 2010, but I really never claimed it as a residential because I had my sister living in there. And I was at a point when I moved, couldn't pay both mortgages or rent and that mortgage. So it's
Sure.
like I never really told the accountant about it.
Okay.
So now that she left and we're able to we just decided let's fully pay it off, which what we did, and now the money's just is cash for us if we don't have any repairs or
Okay.
anything like that.
So a couple things. One is we would want to find out when your tax preparer claimed it as a rental. So they may have gone back and said, I mean, technically, according to the law, it was a rental probably when your sister was there. But if you didn't claim it, if I was your CPA, I would probably just say it was a rental after your sister moved out when it became a full-fledged rental and you started getting money on it. But again, we would have to look at your tax returns and figure that out. But let's use the example where it became a rental when your sister moved in 2010. We could do a cost segregation study on it. The nice thing is you would get all the missed depreciation from 2010 to 2024. So you get 14, 15 years of missed depreciation, and you get to bring all of that forward onto your current tax return without having to amend any prior years. So we didn't really talk about that, but that's a great thing to talk about. It's called a look back study or a catch up study. So you don't have to do cost segregation on assets the first year you buy them. You can do them in future years. And so, again, in this example, you bought it 14 years ago. We can do the cost seg study now. We act as if we did it 14 years ago, and we bring all that missed depreciation forward. You do have to fill out, there's an extra tax form. It's called the 3115 or 3115. We do that as part of our service here with your report. But that it's interesting on that tax form, you're saying, hey, I should have been depreciating my carpet over 5 years. I've been depreciating my carpet over 27 and a half. And because of that mistake on my part, I need all that missed depreciation now. And they let you, it's an automatically, you don't have to do any amended returns. It's an automatically accepted change. So yes, you can do it. That answers hopefully that question. Yes, I'll ask this question, and you don't have to answer it if you don't want to. But what did you pay for that house when you originally bought it in 2008?
Yeah, no, I paid 120.
Okay, so that is one limiting factor with cost segregation. If you paid 120 and you've owned it for 14 years, you've basically taken half of the depreciation. And so there's only half left that we can segregate and bring anything forward. So my guess is, without running numbers, but my guess is we could do a cost seg study. We might be able to save you $2,500 in taxes, but you got to pay us $3,000 for a study. So you end up, it's a wash.
Got it.
So I would say anything over about 250,000 of depreciable basis is worth doing an analysis for to see if it makes sense. Anything less than that, technically you can still do it, but financially it just doesn't make sense because, again, you might save $2,500, but if you got to pay $3,000 to get it done, it doesn't make sense. So hopefully that answers that question. On the LLC question, I can't really give any advice there. We don't set up the LLCs here, so that would be a question for your tax advisor on whether there would be any tax benefits of setting up an LLC. My guess is there probably will be, just based off the knowledge that I have. But I don't really know. I would have to know your whole situation, and like I said, I'm not that well versed in entity structure. But definitely want to talk to a tax advisor because there may be some asset protection in setting up an LLC as well as some potential tax savings opportunities. But I can't give you much advice there. Sorry.
100%.
No worries. Thank you very much.
You're welcome.
All right. Well, one last question, because what I'd like to do too is, Erik, I would, of course, I'll send an introduction email to all of our members because everybody's doing deals and they need your services. So I'd like to do maybe one more question if anybody has anything, and then if you're not opposed to it, Erik, maybe in another 8 weeks or so you come back on and do some more if you're not opposed to that.
Yeah, no, I'd be happy to do it.
Anybody else have one last question before we get moving at the end of the night? All right. Well, then what we'll do then is, like I said, is Erik, again, I want to thank you again for making it on this evening, man. I thought I knew a little bit about, I was like, it was almost like dealing with like a dipping my toe in a pond when you're kind of the king in the court of the ocean. So I want to thank you for making it on this evening. What we'll do, Erik, and to everybody here is, I'll upload this to our podcast. I'll upload this to our YouTube. But most importantly, I'm going to send privately your information to our group specifically.
Okay, sure.
And even an email too to introduce you to everybody. So that way, as they're going and doing their own business, they can get directly with you. And then maybe in a couple of maybe another month or so, month and a half, love to maybe even have you on just to kind of do a little part two if you're not opposed to that.
Sure. No, that would be great. We'd be happy to do that. So, yeah, thank you guys. And as he sends out our information, please don't hesitate to use this as a resource, you guys. We're kind of a niche accounting firm. Like I said, we just do these cost segregations. It's not, You call me. I'm not going to send you a bill for my time. Just if you have questions, reach out. We want to be a resource. I think the weirdest question I've been asked is how to depreciate deer at a breeding facility in Wisconsin. And I didn't know the answer to that, but we were able to get them the answer. So
Appreciate
please
deer,
don't.
like the animal.
Yeah, they had like one of those farms where they raise these animals with big antlers, and you go pay ridiculous amounts of money to shoot them from the porch. It was one of those types of
Oh,
places.
that's hilarious.
But please use this as a resource, guys. I will tell you, I'm not a CPA, so if you send me questions about earned business income or child tax credits, I don't know anything about that stuff. So I know about 6 pages in the tax code about depreciation and real estate taxation. So again, if you have any real estate questions, depreciation questions, I'm happy to help, or at least try to get you the answer, but definitely use this as a resource.
That's awesome. Erik, man, this has been great, brother. Thank you so much. This has been awesome. We'll get this thing uploaded and everything. I'll send this over to you guys. Very, very, very insightful, man. Thank you so much. We'll get this thing rolling, and I'm excited to introduce you to all of our team, man. Thank you so much.
All right. Sounds good. Have a great day.
Okay.
Have a great night,
Thank
you
you,
guys.
man. Thank you,
Take
everyone,
care.
for making it on. We'll see you guys next time. Thank you.
Bye bye.